Throughout the nation, throngs of people thankfully celebrate the end of the war in Europe.
Since the end of the Second World War, the United States has been the world's superpower. And the strength of the US dollar as the dominant international currency plays a key role in its influence on the global stage. Despite constant predictions of the dollar's demise, nearly 60% of the world's central bank's foreign exchange reserves, the money to cover unexpected financial emergencies, are invested in dollar-denominated assets. The share of the US dollar as a global payments currency is more than 40%, while its share of international debt and loans are over 60% and 50% respectively. Besides being the go-to currency for international financial transactions, commodities such as oil are also bought and sold in US dollars. The dominance of the dollar in transactions extend to the US banking system too, which is in turn influenced by America's fiscal and monetary policies.
And while that may seem like good news to Americans, it's bad news for much of the rest of the world.
Eswar Prasad is an economist at the Brookings Institution and a professor at Cornell University. He's written about the enduring dominance of the US dollar.
So here is the paradox. The rest of the world despises how dominant the dollar is, yet they go to the US dollar because there really isn't much of an alternative.
This is why the US dollar is often referred to as the cleanest shirt in the currency laundry basket. Its attractiveness is due to a number of factors, including the size of the US economy and its reserve currency status among the world's central banks, and that it's ultimately proved to be a reliable source of economic growth.
When the US economy is doing relatively well compared to the rest of the world, the dollar strengthens. But there is an additional feature. Money flows into the US dollar because that's seen as the safest currency to put money in during troubled times. So all of this is ultimately going to entrench the dollar's dominance even further. That is certainly a serious problem for low-income countries that have high levels of foreign debt, especially dollar-denominated debt.
Developing nations are increasingly reliant on the US dollar for borrowing and trade, which can have serious implications domestically, especially during times of turmoil.
When the US Central Bank, the Federal Reserve, started to raise interest rates in March 2022 to combat inflation, investors flocked to US dollar-denominated investments such as bonds and fixed deposits. The US dollar index, which weighs the USD against a basket of 6 currencies, would eventually hit a record 20-year high in September of 2022, feeding into inflationary pressures abroad. Many low-income countries that borrowed in dollars to import necessities like food and oil soon got into difficulty. Average consumer prices globally grew by nearly 9%, and in the case of Sri Lanka, it registered a 50 percentage point increase. As prices increased, the dollar reserves held by these countries began to run dangerously low. Depleting reserves contributed to the worst economic crisis in Sri Lanka's history, and the resignation of the country's president. Ghana and Egypt also faced rising food prices and a flight of foreign investment out of the country. And Pakistan was struggling to pay back its loans when the rupee hit a record low against the dollar. In other parts of Asia, the strength of the dollar also brought back painful memories of the financial crisis in 1997, when Thailand's central bank ran out of US dollars, which spooked investors. The chaos quickly spread to South Korea, Indonesia, and other countries in the region. Many countries outside the US borrow in dollars because foreign investors don't have confidence in their currency. This means that when the value of the dollar strengthens, it becomes more expensive to pay back debts out of local currency revenues. While a strong dollar does mean that European and Asian exporters have an edge over domestic producers in America, it doesn't cover the higher cost of borrowing the dollar.
On the other side, you might think a strong dollar is benefiting the US, especially in terms of imported goods being cheaper. But it turns out that the US does not import that much, so much of the world suffers from a very strong dollar, while on the flip side, the benefits of a US dollar are small and transient.
And then there's this sort of vicious cycle for these emerging markets whereby they need the dollars, but at the same time, it's just exacerbating the problem by depreciating all these emerging markets' currencies.
Yeah, so there's a vicious cycle.
Johanna Chua is the chief Asia economist for American investment bank Citigroup.
A lot of solvency risks is triggered by a liquidity risk. So when you strengthen the dollar, you actually erode the purchasing power, the buyer's purchasing power of a lot of the other countries whose currencies are depreciating. But it's also the dominant currency for global funding. And to the extent that a lot of countries, particularly emerging market countries, they finance themselves in dollar, you essentially make the cost of dollar borrowing more expensive.
Some economists also believe that a stronger dollar has allowed America's global GDP and trading power to go above and beyond the levels it would otherwise have reached. This has led to a growing resentment over the dollar's dominance and led to many countries looking for alternatives.
But we are beginning to see countries trying to break free from the grip of the dollar. And so China has set up the CIPS, the cross-border interbank payment system, which could in principle allow China to start conducting payment transactions with other countries, including rivals of the US, such as Russia, but also potentially allies of the US, such as the European countries, who are also frustrated about dollar dominance.
Quite remarkably in China, if you look at the amount of goods trade denominated in renminbi, it actually went up quite a bit. And this is in a backdrop where the dollar was strengthening and renminbi, for the most part, actually depreciated. And yet, there's a greater share of trade settlement. There's still some institutional deficiencies in terms of investor protections in China, given what we've seen with what happened with tech and property sectors. But I think that's the direction China will want to go, to put renminbi forward as an alternative.
There are clear signs, however, that the US's economic dominance has shrunk, especially in the last 20 years. The share of global output and trade has shifted towards emerging market economies, particularly China. The US economy now accounts for about a quarter of global GDP, down from 30% in 2000. The emergence of digital currencies could play a significant role in reducing the reliance on the dollar. These new technologies have made international payments, which were often slow and expensive, much easier, and alleviates frictions that came with trading in multiple currencies.
We've seen digital payments proliferate in developing countries, but also fintech provides a way of providing very basic banking products and services for managing credit, risk, savings, even to low-income households at broad scale. We can also think about fintech reducing the constraints on international payments. But the reality right now is that it's going to require fundamental reforms at the country level, but also at the international level to break free of the grip of the dollar.
But does the US want to weaken its dollar? After all, the currency's might plays a key role in the country's soft power.
What we're seeing in the recent geopolitical conflict, there's also the risk that a very dominant dollar means that that national government might use its currency policy for geopolitical objectives. So whether it's imposing sanctions or controls directly or indirectly, or influencing public institutions like SWIFT, that does create also a geopolitical risk premium for other economies that may not be aligned with the West.
And it appears that policymakers in Washington are adamant that a stronger dollar is in the best interest of the United States.
So we're seeing these incipient movements to break away from the dollar, but none of them has gained any serious traction yet. And given the geopolitical fractures we are seeing within each region and across the world, I don't see much likelihood that that will happen and in any way seriously threaten the dollar's dominance.
For there you're as free as the tumbling weed right into the western sky.